Using debt the rich way. Sarah walks into a dealership and signs papers for a $40,000 car loan. Michael walks into a bank and signs papers for a $400,000 investment property loan. Both are taking on debt, but only one of them understands the game. Sarah pays $600 every month for her car. After 3 years, she's paid $21,600 and her car is worth $25,000. She's lost money every single month. The car depreciates faster than she pays it off. She's underwater on a depreciating asset. Michael's property generates $2,800 in monthly rent. His mortgage payment is $2,200. He pockets $600 every month, plus the property appreciates in value. His tenants are literally paying off his mortgage while he builds wealth. 5 years later, Sarah is still making car payments on a car worth almost nothing. Michael owns a property worth $500,000 with only $200,000 left on the mortgage. His net worth increased by $300,000, while Sarah's decreased by $40,000. This is the power of leverage. With $100,000 cash, you can buy one property. With leverage, you can buy 5 properties with $20,000 down on each. If properties appreciate 5% annually, one property makes you $5,000. 5 properties make you $25,000. The government rewards Michael for using debt strategically. Mortgage interest is tax deductible. Depreciation reduces his taxable income, even though the property is gaining value. Repairs and improvements are write-offs. His debt is actually saving him money on taxes. The wealthy use debt as a wealth-building tool. The poor use debt to buy things that lose value. Why the rich don't earn salaries. David wakes up at 5 a.m., drives to work, punches a time clock, and trades 8 hours of his life for money. Before he even sees his paycheck, the government takes 30% for taxes. David is selling his time, and time is the one thing he can never get back. Emma wakes up at 8 a.m., checks her phone over coffee, and sees money flowing into her accounts. Dividend payments from stocks, rental income from properties, profits from businesses she owns. Emma makes money while she sleeps because she owns assets that work for her. When David gets sick, his income stops. When he takes vacation, his income stops. When he retires, his income stops. Emma's income continues whether she's working, sleeping, traveling, or retired because her assets keep producing money. The government taxes David's earned income at rates up to 37%. Emma's capital gains are taxed at 15 to 20%. The system literally punishes people for working and rewards people for owning assets. The wealthy structure their income strategically. Maybe 10% comes from salary, 40% from dividends, 30% from real estate, 20% from business profits. They diversify their income sources and optimize for tax efficiency. Average people get 90% of their income from salaries and 10% from everything else. Wealthy people flip this completely. They minimize earned income and maximize asset-based income. Legal tax loopholes. Tom walks into H&R Block with his W-2 and pays $200 to file a simple tax return. Richard walks into his CPA's office with a team of tax strategists and pays $50,000 to implement complex tax strategies that save him $500,000 annually. Real estate depreciation is pure magic. Buy a $500,000 rental property, and the government lets you deduct $18,000 annually for depreciation. Even if the property is gaining value, you get to pretend it's losing value for tax purposes. Business ownership unlocks massive tax advantages. Your car becomes a business vehicle. Your meals become business meetings. Your travel becomes business trips. Your home office becomes a business deduction. Everything becomes tax deductible. The wealthy create complex entity structures, multiple LLCs, family trusts, charitable foundations. They spread income across entities, shift assets between generations, and use legal structures to minimize taxes permanently. Specialized investments offer unique tax benefits. Oil and gas investments get depletion allowances. You can deduct 27.5% of income, even if the wells are producing more than ever. It's like getting paid to invest. ProPublica analyzed billionaire tax returns and found they pay an average effective tax rate of 8%. Middle-class families pay 22%. The wealthy aren't cheating. They're using legal strategies most people never learn about. Cost segregation studies let property owners accelerate depreciation. Instead of depreciating a building over 39 years, you can depreciate components immediately. A $1 million building might generate $300,000 in first-year deductions. The power of cash flow over net worth. Dr. Jennifer has a $2 million house, luxury cars, and designer everything. Her net worth looks impressive on paper, but she struggles to pay $15,000 in monthly expenses. Robert lives modestly but generates $8,000 monthly from rental properties and dividend stocks. Who's actually wealthy? Jennifer's lifestyle requires constant money flowing out. Mortgage payments, car payments, insurance, maintenance, property taxes. Her assets cost money instead of making money. She's asset rich but cash poor. Robert's assets generate monthly cash flow. Rental properties produce rent. Dividend stocks pay quarterly. His modest lifestyle costs $5,000 monthly, but his assets generate $8,000. He has $3,000 extra every month to reinvest. When markets crash, Jennifer might be forced to sell assets at a loss to pay expenses. Robert continues collecting rent and dividends, regardless of market conditions. Cash flow provides stability that net worth cannot. Cash flow provides immediate returns you can spend today. Appreciation provides future returns you might realize someday. The wealthy prioritize cash flow because it provides financial freedom now, not later. Financial freedom happens when passive income exceeds living expenses. If you need $5,000 monthly to live, and your assets generate $6,000 monthly, you're free. You don't need a job, boss, or schedule. Compounding at scale. Amy and Brad are both 25. Amy saves $500 monthly from her job and starts with nothing. Brad invests $10,000 monthly using family money and business profits. Both earn 10% annually. Let's see what happens. After 10 years, Amy has $95,000. Brad has $1.9 million. Same percentage return, but Brad's larger capital base generated 20 times more wealth. This is why starting capital matters more than most people realize. Brad doesn't just invest in index funds. He uses his profits to start businesses, buy real estate, access private deals with 15 to 20% returns. His wealth compounds faster because he has access to better opportunities. Amy is limited to her 401k and savings account. Brad accesses hedge funds, private equity, real estate syndications. These investments require minimum investments of $100,000 to $1 million. Amy can't even participate. After 30 years, Amy's $500 monthly becomes $1.1 million. Brad's $10,000 monthly becomes $22.6 million. The gap doesn't just widen, it explodes exponentially. Early access to capital creates generational wealth differences. Wealthy families pass assets to the next generation through trusts and estate planning. The compounding never stops. Poor families start over each generation. Rich families compound wealth across centuries. Time is the most powerful factor in compounding. $1 million invested at age 25 becomes $45 million by retirement. $1 million invested at age 45 becomes $7 million. Starting early with significant capital is the ultimate cheat code. Private deals and insider networks. When you buy Apple stock, you compete with millions of investors worldwide. When wealthy people invest, they get invited to private boardrooms where deals are made before the public ever hears about them. Marcus gets a call from his private banker about a startup going public next year. The company needs $50 million in pre-IPO funding. Minimum investment is $1 million. Expected return is 5 times their money when the company goes public. These opportunities don't come through advertisements. They come through relationships. Golf games at country clubs, charity galas, private dinners. Business is conducted through personal networks that take decades to build. Private deals often generate higher returns because there's less competition. Public markets average 7% annually. Private equity averages 15%. Real estate syndications average 20%. Exclusive access means exclusive returns. Wealthy investors don't just get better deals, they get better information. They learn about regulatory changes, market trends, business opportunities months or years before the public. Information is the ultimate insider advantage. The infinite banking system. Traditional banking works like this. You deposit money at 2% interest, the bank lends it out at 6% interest and keeps the 4% difference. You're financing the bank's profits with your own money. Wealthy people create their own banks using specially designed whole life insurance policies. They overfund these policies to build massive cash values that grow tax-free and can be borrowed against. Here's the magic. When you borrow against your policy's cash value, the money continues earning interest as if you never borrowed it. You can use the loan to buy real estate, start businesses, or make investments while your cash value keeps growing. Bank loans require credit checks, income verification, and approval processes. Policy loans require none of that. You're borrowing your own money. No credit checks, no income requirements, no approval needed. The tax advantages are incredible. Cash value grows tax-free. Loans are tax-free. Death benefits are tax-free. It's like having a Roth IRA with no contribution limits and immediate access to your money. These policies create multi-generational wealth. When the original owner dies, beneficiaries receive tax-free death benefits and inherit the cash value system. The family bank continues operating across generations. Businesses use infinite banking to finance equipment, inventory, and expansion without traditional bank loans. They become their own financing source, keeping interest payments within the family instead of paying banks. Asset protection strategies. Dr. Williams built a successful medical practice worth $5 million. He owns everything personally: his practice, real estate, investments, cars. One malpractice lawsuit could wipe out everything he's worked for. Dr. Williams hires an asset protection attorney who restructures everything. His practice goes into an LLC. His real estate goes into separate LLCs. His investments go into domestic and offshore trusts. His personal assets become unreachable. When the malpractice lawsuit hits, it can only reach assets in the business LLC. His personal real estate, investments, and other assets are protected in separate entities. The lawsuit settles for the business insurance limits. Domestic asset protection trusts in states like Nevada and South Dakota offer incredible protection. Assets transferred to these trusts become unreachable by creditors while still allowing the original owner to benefit from them. LLCs provide charging order protection. If someone sues you and wins, they can't force the LLC to distribute money to pay the judgment. They can only receive distributions if the LLC chooses to make them. This makes lawsuits less attractive. Even basic strategies provide significant protection. Homestead exemptions protect primary residences. Retirement accounts are generally protected from creditors. Proper insurance coverage handles most liability issues before they become problems. The biggest cheat code isn't any single strategy. It's understanding that there are two different games being played. Most people are playing checkers, while wealthy people are playing chess. Same board, completely different rules. You have a choice. You can continue playing the game you were taught. Save money, avoid debt, work for salaries, pay full taxes. Or you can start learning the game wealthy people play. Use debt strategically, build assets, minimize taxes, access better opportunities. The game is rigged, but now you know how it's rigged. The question is, what are you going to do with this knowledge?